Hi guys, so this is the next video in the chapter 3 series. In the previous video, we looked into the main monetary policy instruments used by the Central Bank of Sri Lanka. But apart from that, there are other instruments that we will look into today briefly. Open market operations. So the buying and selling of government securities like treasury bills, bonds by the central bank is known as open market operation. So basically when CBSL wants to reduce the money supply, they would sell securities. And if they want to increase the money supply, they would buy back the securities. So these securities when sold will be carrying a lucrative interest rate as a return. And since it's government security, it tends to be a more safe investment. Next, the standard requirement rate or the SRR. So this basically is the percentage of commercial bank deposits that should be maintained in the central bank. If the rate is increased, money supply will reduce, while if the rate is decreased, the money supply will increase. In order to understand this, let's look into how a bank operates and how this SRR would affect them. Now the major source of income for a bank is interest, and that is obtained through lending money. A bank would definitely want to maximize its interest earning potential by lending out all possible deposits they have. Assume if the bank has a deposit of 100 and the SRR is 8%, then the bank should keep 8 rupees with the central bank and lend the balance 92. So if the SRR is 10%, then the bank will have the ability to lend only 90 rupees this times. So CBSL, if they want to reduce the money supply, they would increase the SRR, or vice versa if they want to increase the money supply. Next, imposing credit limits. So credit limits could be imposed either quantitative method or a qualitative method could be used. Quantitative credit limits are where the CBSL controls the total credit by increasing and decreasing bank credits, which impact on the total money supply. So the central bank could set up rules like minimum ratios between the asset and liabilities that a bank should maintain, and rules like minimum money to be deposited when issuing letter of credits, etc. Next, the qualitative credit limits. Here, the central bank tries to control the direction in which the loans are provided. So central bank tries to motivate banks to provide loans to agricultural industries, entrepreneurs, etc. and also tries to demotivate certain industry which provide demerit goods and services like tobacco industry. Changing the discount rate. The money supply of an economy can also be controlled through changing the discount rate when the parties who have bought government securities discount them at commercial banks before their maturity date. So what basically happened here is, so central bank issues government securities like treasury bills and bonds. So the commercial banks and the primary dealers buy them from the government since they are a safer investment, and also at the end of the maturity period they will also be given an interest payment along with the capital. So at times where they are in need of any liquidity requirements, they could sell this to the commercial banks at a discount rate. That is, if at the end of the maturity period they receive 7%, they would sell them at 4% to the commercial bank and get the money. And the commercial bank that has bought this would receive the balance 3%, and that is their gain on this transaction. So if CBSL amends the discount rate and reduces it considerably low, then this would discourage banks to discount them, and hence the money supply will contract, and vice versa could happen if the discount rate are increased. Moral suasion. So this is the act of persuading a group or a person. So in this case, the CBSL tries to persuade the commercial banks to act in a certain way through either influencing or directly or indirectly threatening and also using other activities without implementing a existing law or creating a new law. So for an example, CBSL could influence on commercial banks to take specific decisions on reducing the amounts of loan given to production of demerit goods or services without implementing a law or a regulation. So they try to influence and get things done. Foreign exchange operations. Foreign exchange operation refers to the efforts taken by the Central Bank of Sri Lanka to stabilize the local currency. So if the rupee tends to be strong for other countries, they would find it difficult to afford our goods and services. Hence, Sri Lanka would find it difficult to export. So at those situations, CBSL would intervene and may set a minimum exchange rate to carry out business activities smoothly. So this could happen vice versa as well. So that's it with this video guys. Please do like and share to learn and let others learn. Thank you.